Hollow Point Trading presents Operation Quicksand. This briefing covers the $114 billion liquidity drain, the market top, and the current economic regime. Before we begin, please note that this video is for market commentary and education purposes only. It is not financial advice, and you should always do your own research and manage your own risk. The thesis is clear: the memory trade has peaked. Liquidity is being drained by massive new listings, while retail investors are buying into cyclicals, just as the smart money prepares for a supply glut in 2028. Our analysis is split into two files. File 1 covers the liquidity drain and market rotation. File 2 examines the broader economic regime, including the jobs data and Federal Reserve policy. We stand by our record. Our analysis of the supply glut in Micron and the collapse in AI memory stocks like SK Hynix was shared weeks ago, long before the recent market shifts. The first trigger for this shift was Samsung's latest earnings report. Despite an earnings beat, the market reaction was immediate and severe. Samsung's preliminary Q2 results were technically a beat, but the market didn't care. Seoul's reaction was one of panic. The KOSPI index dropped 8%, forcing a 30-minute trading halt. Samsung closed significantly lower, proving that positive news couldn't offset the negative sentiment. This exhibit highlights the severity of the KOSPI halt. When good news results in a massive sell-off, it is clear the market is looking past the current quarter. Market tops are almost always formed on good news. When the best possible outcome is met with aggressive selling, the marginal buyer has exited, marking a trend reversal. As we noted, when a beat is met with a limit-down halt, the message from the market couldn't be clearer. Don't get distracted by debates over whether a report was a beat or a miss. Focus on the market's reaction, which is the only signal that matters. Next, we examine the $114 billion liquidity vacuum. Remember, initial public offerings don't create new capital. They absorb existing liquidity. The market is a closed pool. When a massive listing occurs, it acts as a drain, pulling cash from other investments and reducing the capital available for other assets. The SpaceX IPO alone drained $85 billion from the market. Following that event, the Qs peaked and have been trending downward ever since. Many argue that Nasdaq inclusion is a major milestone, but it is effectively just a liquidity event. It's not a business model. We see the same cycle: meme, drain, and bleed. Don't fall for the narrative. This Friday, SK Hynix lists its ADR, pulling another $29 billion out of the market. This is the largest liquidity extraction of the week, and it's a scheduled event. Combined with the SpaceX IPO, we are looking at $114 billion pulled from the tape in just 4 weeks. There is simply no money left to chase hardware stocks, forcing a rotation. People ask why hardware is selling off when the AI story seems intact. The story may be intact, but the bid is not. That's the difference between narrative and reality. Our house rule is simple: don't fight a scheduled liquidity vacuum. You know the date, so plan for it like an FOMC meeting, because that is exactly what it is. We must remember that memory is a commodity. Pricing power in a commodity is a countdown timer, not a permanent moat. Markets have largely forgotten this reality. Hyperscalers are currently paying anything for memory because demand for DRAM and HBM is high. Producers have maximum leverage right now, but the market is looking toward the future. Micron once claimed supply would never meet demand. History shows that such statements are infamous last words in the market, often marking the top of a cycle. The iron law of markets is that high prices cure high prices. When producers insist a shortage is forever, it's usually the cue that the top is forming and overbuilding has begun. This exhibit illustrates the inevitable crossover where supply begins to catch up with demand. It is a mathematical certainty in a capitalist cycle. Bernstein estimates supply-demand equilibrium for DRAM might arrive by early 2028. After that, we expect excess supply to persist for years as new capacity comes online. The fab avalanche is real. This chart shows the massive increase in production facilities coming online, which will fundamentally shift the supply curve. Micron's expansion isn't just a forecast, it's poured concrete. From Idaho to Singapore to New York, new megafabs are scheduled to start production through the end of the decade. The math is staggering. A 37% increase in footprint will lead to 50% more effective capacity. New fabs are simply more efficient than old ones. It's not just Micron. Samsung and SK Hynix are doing the same thing. 3 major players adding capacity into one demand curve is a classic recipe for compressed margins. Companies engineer scarcity on purpose to hold the pricing floor. Memory economics rely on capacity utilization, But the boom-bust cycle is exhausting, forcing firms to fire and rehire staff constantly. Remember 2023? Micron lost billions, yet now it prints them. This cycle isn't a bug, it is the business model. You are currently buying the peak of the flip. This exhibit details the relationship between earnings per share and market price, showing how the market anticipates the cycle well in advance. Markets price 18 to 30 months ahead. We are roughly 18 months from the projected equilibrium point in 2027. While earnings are currently rising, the stock is pricing the eventual glut. Let's break down the math for the bag holders. What you are actually buying when you invest in memory this week requires a closer look. When you buy now, you are purchasing a commodity at peak pricing power and peak margins, during a peak narrative, while supply expansion is already scheduled. You aren't early to a supercycle, you are exit liquidity. This chart illustrates the cycle and the reality of the math behind the current market position. In 2023, these companies were losing billions and nobody wanted them. In 2026, everyone wants them at multiples of the price. That is not investing. It is donating with extra steps. Memory names belong in a trader's book, where they are timed and returned. Treating them as 8-year buy and hold investment is how capital is lost. We called this memory top in public, weeks in advance. Today's market tape is simply the math catching up to the reality we outlined earlier. This isn't a market crash, it's a rotation. The equal weight index is hitting all-time highs, which tells you everything you need to know about where capital is moving. The equal weight S&P 500 reached all-time highs this morning. Crashing markets don't do that. Rotating markets do. Read the internals, not the headlines. Think of the recent market momentum as an arrow that hit a power line. It fractured, sending one part into healthcare and another into software, while the hardware sector fell. This exhibit shows the split, demonstrating how different sectors have reacted since the June 12 pivot point. Healthcare, represented by the XLV, bottomed early and is now at highs. Major players like Eli Lilly provide stable compounders for those avoiding the lottery of commodity cycles. Software saw a V-shaped recovery about a week after hardware. Cybersecurity remains a compelling AI narrative, keeping valuations high. Watch the RSP, XLV, and IGV gauges for clues on rotation health. They are instruments to monitor, not necessarily to buy. When software stays green on a hardware bloodbath day, the market is signaling a rotation. This slide highlights the contrast on the board. Hardware stocks like Rivian, Intel, and others face significant declines, while software names remain green. Note the intraday halt on Samsung following a report, underscoring the volatility in the hardware sector. The market action on July 7th tells a clear story. Money didn't exit the market entirely. It rotated out of hardware and into software. While hardware names like Rivian and Intel were heavily sold, software companies like Cloudflare and Microsoft showed resilience, reflecting a shift in investor focus. Looking at AMD as an example, this chart maps a one-day trade. Driven by news of a delayed NVIDIA rack, the stock saw a significant intraday move. It serves as a reminder that these situations are often best treated as short-term rentals rather than long-term investments. The AMD example emphasizes a key rule: treat these moves as rentals, not marriages. When a hardware catalyst occurs, the move is often fleeting. Those who confuse a short-term trade for a long-term commitment end up paying the price as the tide turns. Friday is the deciding factor. The current activity surrounding SK Hynix is a critical event, and the market verdict will become clearer next week. In our base case scenario, the market stabilizes. As index pressure lifts, we expect healthcare and software to lead. RSP performance continues to support a rotation thesis, and we view dips in the right sectors as buying opportunities. In the red flag scenario, hardware continues to slide. If QQQ loses key levels, it could pull the entire market down. In such a case, our rotation thesis is suspended, and preserving capital becomes the priority. Here is the Quicksand playbook. For the short term, maintain a bearish view on hardware and prepare for potential liquidity events. The pivot involves monitoring leadership in healthcare and software, while our long-term strategy focuses on buying dips in quality sectors and staying disciplined. The danger of quicksand isn't its depth, it's the panic that follows. Struggling against the market's clear direction leads to losses. Success comes from reading the structure and aligning your strategy with the prevailing trend. We are entering a new regime. The Fed put is no longer a given, and we are navigating a complex environment defined by the ongoing inflation and deflation debate, with 2027 emerging as a pivotal period. The regime change we identified months ago is now apparent. Previous years of central bank intervention trained investors to expect a safety net, but that era has passed. Today's tape is a direct result of this shift in policy, where reflexive bids are no longer guaranteed. There are two competing views in the market today. One side anticipates a deflationary boom driven by productivity, while the other warns of persistent inflation caused by policy errors. This exhibit breaks down the core arguments of both perspectives. Examining the deflationary boom case, the argument rests on a productivity surge and a yield curve that suggests the bond market is pricing in long-term deflation. Proponents believe this growth can outpace debt, despite current inflationary headlines. The yield curve is telling a story. While the short end signals inflation, the long end is pricing in deflation. Together, both ends of the curve reflect the market's concern regarding potential policy mistakes. The latest jobs report challenged the narrative that labor market cooling is simply a result of people becoming AI entrepreneurs. Data shows real, measurable shrinkage in the labor force, contradicting the idea that 1 million workers are quietly starting their own ventures. This jobs report autopsy reveals significant misses across key sectors. From healthcare slowing down to negative hiring in leisure and hospitality, the data points to genuine contraction rather than structural shifts. The numbers indicate a flashing console light for the economy. With a negative 3-month average in household data, we are seeing historical signals of a recessionary window, suggesting this is recession-driven deflation rather than growth-led stability. Regarding the inflation warning, the thesis that AI is immediately deflationary may be premature. Current massive infrastructure buildouts act as a stimulus, while potential wealth effects from market performance keep upward pressure on prices. The J-curve demonstrates that efficiency gains often come after a period of initial struggle. The token maxing phase represents the costly learning period, while the mastery phase is where we expect true deflationary benefits to emerge. Firms tend to get less efficient before they get more efficient. Investing heavily in compute without workflow discipline is inflationary, but it is a temporary phase that precedes the mastery stage. Data analysis often refutes its own premise. While some charts use memory prices as a proxy for demand, they also show that current supply bottlenecks have clear expiration dates on the horizon. The tripwire from market sentiment fired in the wrong direction. Market watchers expected an employment reacceleration to signal hawk-like policy, but the subsequent data instead highlighted recessionary internal dynamics. Unlike previous debt-fueled cycles, the current AI buildout is funded by operating cash flow. This creates a kill switch. Should hyperscalers decide to trim spending, the inflationary impulse can evaporate rapidly without a debt unwind. The 69-day U-turn in capital spending by major tech firms highlights how quickly the narrative on infrastructure investment can shift, validating our view on the potential for rapid adjustments in the sector. In synthesis, we are looking at two distinct phases. Through 2027, the build-out remains inflationary. However, from 2027 to 2029, we expect a transition where capacity floods the market, leading to deflationary pressures. The trend in layoffs forms a pattern that investors should monitor closely. This data is critical for assessing how the broader labor market is absorbing or struggling with the current economic transition. The Warsh regime brings a specific set of policy expectations to the table. Understanding how this framework interacts with current market volatility is essential for long-term positioning. The Fed put, the idea that the central bank will always intervene to prevent market declines is no longer a reliable assumption. This shift fundamentally changes how risk should be managed in the current environment. Finally, we identify the kill zone in the current market cycle. Navigating this area requires discipline, as the transition between inflation and recession-driven deflation will likely create significant turbulence for traditional asset classes. Looking at the history of build-out busts, we see clear winners and victims. Companies with massive cash reserves, like Microsoft, Google, and Meta, are well positioned to survive and dominate, even if growth faces headwinds. They can afford to wait out the volatility and acquire assets when the market reaches its bottom. On the other hand, those likely to suffer the most are entities reliant on infinite capital expenditure, including niche cloud providers and compute middlemen that were valued at cycle peaks. These companies risk becoming bodies if the market regime shifts and spending stalls, proving that being a good company isn't enough at the wrong price. Your posture should be defined by unfettered optimism for the decade ahead, but hedged with professional caution during this transition. Prioritize limited leverage, maintain real cash reserves, and remain decisive. History shows that AI will drive long-term gains, but the real challenge is positioning yourself to survive the immediate crossing. The bottom line is that the market regime has fundamentally changed. You don't need to predict the exact day the kill zone opens. You just need to remain standing, unleveraged, and prepared when it does. Remember, Stay bound by your rules and stay ready.